on board S. Naren, Executive Director and CIO with ICICI Prudential AMC, to talk about the market and take stock of what he's currently making of the market pattern. Naren, when we spoke to you last time, it was sell-off in mid and small cap stocks. Everything in the SMID space, as we call them, was shaking. Now when we are speaking to you, gains in large cap stocks have got cemented, and for a market which was lacking triggers, there were concerns around tariff and geopolitics. Looks like right now there is no worry in the world. So from fear to hesitation, now somewhere between excitement and greed.
Yeah, absolutely. I think when we are investing public money, to find pockets of value has become very, very difficult at this point of time. At least earlier you had, banks were very attractively valued. Many of the large caps look very, very cheap relative to mid caps. Now, today across the board, it's very tough to find which are the big pockets of value. So, sir, I mean, as I was telling people, Indian market is one of the best macro markets in the world. But due to that, it's so difficult to find pockets of cheap value for a equity market investor, like I say Prudential Mutual Fund. That is the challenge actually. Because if something is cheap, every investor buys that part of the market and takes it to fair value. And that is the challenge that we are facing when we are investing at this point of time. I don't think there's any other market in the world where fiscal is under control, current account deficit is under control, inflation is under control, growth is good, so banking system is in good shape. Today, what is the big change between the time we spoke last and now is that liquidity has been improved in the economy thanks to the fantastic effort of the Reserve Bank of India. That today there is phenomenal amount of liquidity in the economy, and therefore, we have a situation, we have a very, very comfortable macro. So it's so tough to find value.
How does one go about investing in this kind of a market where nothing is cheap? Half of the market is either overpriced and other half is actually reasonably priced. How does one go about investing in this market? Because Naren, on a monthly basis, you are getting inflows. And now FIs have also started buying. So there are no sellers in the market, only buyers.
It's tough, actually. So what we tell people is do asset allocation, which means don't put all your money in equity alone. Invest in hybrid. Then we tell people invest in the more safer parts of equity. And, in a way, we tell all the companies which are floating IPOs in the market, come at reasonable prices. Is the best time to come. They want to come costly, but we tell them come cheap. At least you can raise money comfortably. So if they want to raise money at reasonable valuation, there's a lot of money available in India at this point of time. So this is what we tell people, and so we have a very comfortable environment, but you have to use it to raise money at reasonable valuations. Then I think a lot of money can be raised by everybody. It can be raised by corporates, it can be raised by government in disinvestment. But finally at the end of the day, the valuations have to be reasonable. It can't be absurd. And then the challenge will come.
Naren, last time again when we spoke to you, you said cat amongst the pigeon. You really got everyone thinking, wondering, and some of us got scared when you said that cancel your SIPs in small and mid-cap stocks. There is bubble and trouble there. But surprisingly, along with large and mid-cap stocks, small and mid-cap stocks have also managed to bounce back. What explains this excitement in that end of the market? I can understand why large cap stocks are coming back. They were cheap, they were underowned, they were underperforming. But small cap stocks also have seen nothing short of a V-shaped rally from the recent lows.
No, I think there is a lot of money in the market. There is no shortage of money in the market at all. I think the amount of money that mutual funds are getting across the entire spectrum is very, very large. So finally, that money has to get invested. If you look at the amount of cash that the mutual fund industry has in April end, it has gone up by more than 20,000 crores from where it was in March end, because in April they didn't invest enough, so the money cash has gone up. So we have a situation where there is huge amount of money. So I don't think, market movement in the near term is about valuations or something. It's about liquidity, and there is huge liquidity at this point of the market. As I mentioned, the Reserve Bank has also done its bit all the way in the last 3 to 6 months to improve liquidity in the economy. And what we want is that liquidity that the Reserve Bank has pumped has to go into the real economy, not only into asset prices. If all the money that is being pumped by the Reserve Bank goes only into asset prices, it is not good for the economy, because even today, if you look at sectors like FMCG, they are hardly growing. It is only asset prices which are booming substantially. You have to see you have to see FMCG sector doing well. You have to see two-wheeler sector doing much better. You have to see the entry-level car markets doing much better. So, we would love to see many parts of the economy do much better than asset prices just going up because of extremely good liquidity improvement thanks to the Reserve Bank of India.
From your new NFO presentation, I've stumbled a page, Seth Kalman, we all know him, and I'm going to quote him. It is part of a new NFO presentation which we'll talk about. Most investors are primarily oriented towards return, how much they can make, and pay little attention to risk and how much they can lose. And since you've championed the whole idea of risk in this market, where is risk in this market? And for someone who's invested in outside the comfort of large cap stocks, what kind of risk are they exposing themselves to?
Yeah, I think the risk in this market continues to be in the derivative segment, particularly the weekly option segment. I would say that is one of the markets. If you see, even today, I think on the weekly settlements, the market turns out to be very volatile. And that is one area where I would always tell retail investors to do less. And second is, I would say, when they are investing in IPOs of loss-making companies, I think they have to be much, much more careful. So I would say that is a second area. And I think now I don't hear so much of conversations on SME IPO. That was a third area of risk, but I'm not hearing so much in the recent past. I don't know what's happened because we don't participate in that segment. But I would say that is an area which seems to have become smaller. As that boom come down, I don't know, but maybe it has come down. So I would say that was a third area. And I think as such, we are worried that too much of money comes into equity from people who think that equity doesn't deliver negative returns. And again, the quick rebound has given again the feeling that equity doesn't give negative returns. That, is something which worries us, particularly people who have seen longer periods of time. And there are too many investors in the market who've been there after 2013 who haven't seen this. And that is something which worries us all the time. And, because finally, mutual funds are custodians of public money. And therefore, when we try to tell people that there are risks, it is actually because as custodians of public money, we have to consciously talk about the risks rather than talk about the returns. Returns have been fantastic in the last 2 decades, but it is the risk that we have to focus on because people haven't seen the risks. Whereas if you take many of the other emerging markets, people have seen the risks much more than the returns, actually.
Naren, so let's now focus on a very basic investment approach which you've adopted over the years, which is buy fear, sell greed, be contrarian, try and buy what others are selling when you find value there. In that same spirit, you bought telecom, you bought into metals, you bought into banks. I can see one pocket of fear in the market, which is IT. Nobody likes them. Everybody has a view that nothing could go right on IT. Is it a time now for you to put your long-term lens and start buying into IT, especially IT services?
See, we're looking at it. Unfortunately, it's connected to the US market, and US market is not yet value. US market has done extremely well. So if we see some decent setback in the US market, we'll certainly look at IT. That is where we are struggling at this point of time. But the reason why we came to looking at quality was a theme which had not done well from 2020 to 24. That 4 years was bad. So we said, okay, let's look at quality instead of value. because quality was something which had done badly, and we thought that relatively that's an area which peaked in 2020, and we thought that we can try that, and that's how we came to quality. And quality would definitely include IT. It would definitely look at FMCG. If you look at it would look at many of the two-wheelers. So you look at it, it would look at many of the segments of the market which have done very badly over the last 4 to 5 years. And that is how we came to this area. But IT would certainly be part of it. But we're confused at this point of time because the sector is trading at a premium to pre-COVID valuation, and the sector is growing at much slower than pre-COVID. So, if we had seen the valuations being slightly lower than pre-COVID, it would be a very, very interesting contrarian opportunity.
Nothing is cheap in the market. Why have you come up with a NFO which is called as a quality NFO? Because quality stocks are trading at a premium.
No, quality stocks always trade at a premium. You can't expect quality stocks to trade at a premium. Junk stocks are the ones which have to trade at a discount. So it would trade at a premium. But what happens is that when you have a 12-year bull market, after 12 years, people say that you can invest in junk, you can invest in anything and make money. So people actually get tired of quality stocks. So that is why actually people, if you look at the market, you would see that how much money is there in FMCG's stock fund, how much money is there in consumption fund. All these funds have very little money, whereas if you look at the amount of money which is there in small cap funds, it is much, much higher. So I would say that, we have actually 12 years of a big bull market means that people want to actually take a lot of risk in equity, and they don't want to be in the safest parts of the market, whether it is large cap or quality. That is why first we came up with a fund called minimum variance, which was focused on the defensive parts of large cap. And then we said that we should look at quality. So it is exactly the antithesis of what people are doing at this point.
My final question, debt. Macros are great. And given where bond yields are right now, are they also pricing in a near perfect scenario and there is very little room for the debt market now to rally from here?
Yeah, see, it's a big problem because, in India, you look at it unlike US, for example. In India, we are at the lowest interest rates in years on 10-year, whereas in US, we are at possibly one of the highest interest rates in years on a 10-year basis. In fact, almost across the world, you are at the 10-year GSEC is at, except China and India, I think across the world, you are at the highest yields in 10-year. So the least value at this point of time in debt is seen in China and India, and it's seen at and the most value is seen in the entire Western world. So it is very tough at this point of time for us to tell people that Indian debt is a great asset class. That's the challenge today. Neither is Indian debt a great asset class. Gold is even worse. So, one of the ways in which we judge how much an asset class is, let's say, too much in focus is the number of questions we are asked. Actually, the asset class which is most in vogue right now is gold. If you go for any meeting, the number of questions we get on gold is unbelievable at this point of time. So gold is at all-time high. Yeah, 10-year yields are at almost at all-time low, except in crisis periods, it has never been at these yields. So it's been a very, very tough period on where to put money at this point of time. And that is why we tell people put money everywhere, because there is no pocket where you can say that it is cheap, so you can put money there. Even 2 years back, for example, gold and silver were very, very interesting. So we actually thought it was very, very interesting. Now, even that doesn't look at this point of time. In fact, it looks to be the darling asset class of Chinese investors and many of the global central banks of the world. So it's a very, very tough time. So I think it's a time where you allocate money across asset classes and not choose one asset class. And at the same time today focus within every asset class on the safer parts of the asset class because of the way the markets are at this point of time. Does it mean that the markets are going to fall? No, because I think India is one of the best structural stories and where the macro has been handled brilliantly over the last decade. So India doesn't look to be the market which is at risk at this point of time, but at the same time, it is not a market which is value at this point.
All right. Really appreciate your time. Thank you so very much for joining us. And it's been a while we've not met, Naren bhai, for a coffee. बात करते हैं,
Sure.
कॉफी भी बुलाते नहीं हैं.
Sure.
हम बुला लेते हैं आपको next time in our studio. We'll serve you coffee. You're not calling us on
Sure.
All right. Look forward to see you soon. Thank you very much.
Thank you.
All right, taking a look at the markets.
If you like this video, then like, share and subscribe to ET Now.